Good morning, everyone. Thanks for joining us today. The purpose of this session is to update you on our financial results for the 6 months ended April 2020. I'm going to take you through the first couple of slides. Grubb, our CFO, will then take you through the financial highlights, and then I'll cover off our operational activities during the period. Just a reminder, really, Idox is a supplier of next-generation public sector software. We have a great application suite of products, and we are focused now heavily on cloud-based software and cloud-based services, supported by our deep domain understanding of the relevant areas of operation in which we work with our clients. So anything that involves heavy regulation or heavy legislative approaches tends to be the area of our applications and their operation across the public and regulated sectors. Now, over the last period, the last 24 months since I arrived as CEO, we have been spending a lot of our time on making sure that Idox has really set a strong foundations to move forward. We refer, and we'll talk a little bit more later in this presentation, about our 4 pillars program. It's a very systematic way of us bringing the organization together to share common infrastructure, common platforms, and to bring together all of our knowledge and understanding across our various market areas, and to allow us to make maximum use of that in the markets that we serve. Idox previously had been a very fragmented company dealing with several end user markets, and what we've managed to do over the last 2 years is bring that together in a much more cohesive way in order that we can share that expertise across sectors and into new adjacencies. So our strategy over this period and moving forward is to make sure that through that 4 pillars framework, we're driving operational excellence and leveraging our resources in the best way possible. We spent quite a lot of time ensuring that these 4 pillars of revenue enhancement, margin enhancement, organizational simplicity, and improved communication really come together to ensure that when we take business with our clients, we make sure that we don't leak margin, and that really our performance at the top line reflects all the way through to our EBITDA and our cash performance. We have a clear focus on, as I say, on a cloud-first strategy, and also ensuring through our 4 pillars program with communication that the culture across our business is a really strong and cohesive one and reflects our activities with our clients. I'm very conscious, and we're very conscious in our group, that culture always defeats strategy, and so we take a huge amount of time to ensure that our employees are engaged in what we do. We communicate well with them, and we see them as equal stakeholders in our business. I'm pleased to report that all of the work that we've undertaken over this period has produced a set of stronger outcomes, and both Rob and I would like to believe now that the business is in a really strong position, and it's probably given us maximum flexibility as we go forward to ensure that should opportunities arise for bolt-on acquisitions, that we can also now add that into our organization and do so in a seamless way, such that we're not just buying businesses, but we'd be buying and taking on businesses rather like the Tascomi acquisition we did last year, which are complementary to our core operations and can really maximize the use of the infrastructure in sales, professional services, and development activity that we've created. So in brief, our highlights: strong delivery, as we said, across this extensive transformation program across the group, a big improvement in our operating margins half year on half year, and that's come through some really strong improvements to the kind of revenue that we're pursuing. I think in the past, maybe Idox was interested in growth. We, of course, are interested in growth, but only in growth that we believe is margin enhancing and can deliver really strong cash performance. Because of that focus on revenues and margins, we've seen a really strong cash performance, which we'll cover in a little bit of detail, and that's resulted in a very strong reduction in our material net debt, I think from when I first joined the business, we were operating about a 2.75 times leverage, and now certainly below 1, probably about 0.7 as we run forward. And as I say, a really strong focus on our transformation program of activity to improve revenues, margins, communication, our organisational simplicity. So with that, I'm going to hand over to Rob. Rob's going to take us through our financial performance, then I'll come back and talk a little bit about some of those progress areas.
Hey, morning everybody. So yeah, Rob Grubb, CFO of Idox. I've been with the business about 18 months. Actually think I've spoken to most of the participants during that time. So as Dave says, I'll obviously do the CFO bit and take everyone through the numbers. And so year on year, a very strong set of numbers. Clearly, the first half of last year characterised by a lot of change and transformation of the business, as has been much talked about, a lot of new hires, a lot of rebasing of accounting policies and judgments, and that really ran into the second half of last year, a much more sort of normalised run rate, which has continued through to the first half of this year. So year on year, revenues up strongly, up 13%, even excluding the impact of Tascomi, still up around 10%. And there's a few reasons for that. It's a bit of a blend, as I've sort of mentioned, quite a lot of revenue recognition rebasing the first half last year, which obviously is not there this year, with a full 12 months under our belt with the new policies. Of course, the Tascomi acquisition, so we acquired that business in July last year. That gives us around 2.5 million in revenue every year, so that's just over 1 million in the first half. And the timing of the national elections. So in this financial period, we saw the UK general election in December last year. In the comparative period, although we did have a national election in the year, it was actually in May for the European elections. You may recall, we called it very short notice. So year on year, revenues up strongly. Recurring revenues continue to step up quite nicely. There is a continuing focus on recurring revenues, both in terms of commercial models, but also the underlying technologies. As Dave says, we've moved to SaaS and a cloud first strategy. And with all the efforts throughout those periods on both sales governance to make sure that, as Dave alluded to, we're engaging in good quality revenues. We're also protecting revenue leakage, we're also controlling costs very strongly throughout the organisation. So the increased revenue drops very strongly to EBITDA, which is clearly up significantly year on year, well over 100% of what we recorded in the first year. Our quality of earnings now is significantly better than it has been for many, many years. Our cash conversion is much higher, and this is direct result of more sensible revenue recognition policies, very, very tight cost control, and to the fact that the operations of the business, the accounting for the operation of the business just make a lot more cohesive sense, and therefore what we record as revenue and profit converts very, very strongly to EBITDA. So of course, EBITDA up strongly year on year, net debt down significantly. So as Dave says, when we started this journey a little over 18 months ago, we had leverage which was near 3. I'm pleased to say that at the half year we are actually down below 1. April is a invoicing peak for us, so it's pretty typical that we have an April position that's actually slightly better than our previous October close, but then that generally amortizes through to the following April. But all the trend measures show that net debt's coming down very, very strongly. Cash generation from the business is very, very strong, and on the current trajectory, we expect to be in a net cash position in around 18 months' time. Looking at each one of the sectors, so we have 3 sectors: public sector software, content, and EIM. Public sector software is our biggest by far. It accounts for around 2/3 of the business, and a lot of the transformation and repair work that we talked about really happened in the public sector part of the business in the first half of 2019. Tascomi also sits in the public sector business, as does the election variances that I quoted. So a lot of the group's sort of year-on-year improvement has derived from the PSS sector, as you can see from the words on the screen there. Again, significant margin improvement, a lot of change in the senior leadership team in the PSS business over the last 18 months, leading to those improvements in both sales governance, upfront sales governance, which in a lot of cases is actually leading to bigger deal sizes as well as better margins, and also the cost control that I've talked about. Continued focus on all of that, both good sales governance and cost control. And the focus is now very much on improving revenues in this part of the business, both from doing more with the customers that we got and the IP that we got through more strengthening of our account management model, but also looking at our market shares more generally and looking to do more with the IP that we've got in the portfolio. Moving on to our EAM business. So EAM is a document management business for heavy industry, quite a bit of focus, exposure to oil and gas, but also energy more generally. And it's had a pretty good year, year on year. Again, sales are down slightly, but that's as much about our focus on good quality revenue as it is anything else. EBITDA are up strongly because of the higher margins that we're now getting off that better revenue, and also just good cost control generally across the organisation. EAM has always been pretty separate from the PSS business, and there's been more efforts over the last 6 months or so to bring both that and parts of the content business much closer to the PSS core, to help drive operational leverage and margins across the group as a whole, but actually also, really improve the way that we interact with customers and drive account management where that's appropriate. Obviously, oil and gas is a bit of a difficult market at the moment, so we are being relatively cautious in this part of the business, but still have a very high degree of confidence in the long-term opportunities for the product, which we see as very key and strategic for our customers in the way they deploy them in their projects. Then finally, looking at our content business, which is a collection of business services in Netherlands, subscription databases, mainly in the UK, with also some of the Netherlands, and our compliance business, which is a sort of e-learning business based largely in Germany with some presence in Belgium. Again, a pretty strong performance during the year. Down slightly from a revenue point of view, year on year, through a combination of some of the accounting adjustments that we're going through last year, but also just a more blended performance going forward. As I sort of noted previously, trying to align this part of the business generally to the PSS core, and actually specifically the UK databases part, which sells to a lot of public entities in the UK, in some cases local authorities, and in other cases academic institutions. We're actually going to move that directly into the PSS business in the second half and bring that into the existing infrastructures in PSS. So you'll see more about that in the full year results. High margins starting to come through as planned. So again, quite a bit of work in this part of the business, really focusing the operations on high margin activities, particularly in the continent across Netherlands and Germany in those two businesses. Some good progress in the period, but as ever, more to do. And then my next 3 slides are really more of a breakdown of the income statement, cash flow, and balance sheet. I mean, a lot of the discussion clearly is around the operational movements in both revenue and adjusted EBITDA. Everything else is largely in line with plan. Depreciation and amortization up, largely due to the impact of IFRS 16, but also just generally more investment across the organisation in things like our CRM system and other software tools, just to make us more operationally more efficient. Slight increase in interest, again, a bit of an IFRS 16 impact in there, and also some exchange on our Euro bond. Quite a high tax charge, unfortunately. We've done quite a bit of house cleaning from a tax point of view. There's some deferred tax assets that we de-recognised associated with our exit from Malta and Ireland, so there's a sort of permanent one-off differences, but an ongoing effort to really sort of tighten up our ETR generally. Moving down the P&L, probably just want to mention the restructuring costs, which is again quite a big figure, and that's a couple of items. We have a large building in London that we continue to make a provision for, That's about £1 million of the 1.5, and then the other £500,000 is the costs associated with exiting both the Maltese and the Irish entities. So they're all obviously non-recurring. Moving on to our cash flow, there's very little in here, to be honest, that I've not already covered. Probably the thing I did want to flag was the working capital. Working capital processes for us and management continue to be a real area of focus coming into this financial year. Our MI across the organisation is just proving every single month it gets better and better. And working capital is an area where we've really rolled out the focus, not just from a centralised credit control point of view, but really sort of baked it into the operations of the business so that we're looking at this on a monthly basis. Actually, coming into March with the impending COVID-19 pandemic, we were quite keen to ensure that we had very, very early visibility of any issues with cash collection, not least because it was our peak of the entire year. We collect something like a third of all of our cash receipts throughout the back end of March, April, and start of May. And actually, we didn't see any sort of negative effect from the market. Our local authority business in particular, hugely resilient in sort of the wider uncertainty. Customers continuing to pay very, very strongly, in most cases actually being very proactive to signpost to us the way to get paid, which was very helpful. And so actually with all that extra focus, a lot of new processes, working capital came in very, very strongly. Cash collection, very, very strong across that April close, and typically collected a lot of cash that would otherwise have been in May. We are still continuing clearly with all those strong practices. We are keeping sort of current forecasts where they are for the year end, but again, just to flag really that as well as operational focus on things like revenue and margin, and clearly cash generation, working capital, and other things below the line very much remain a focus for us. On the balance sheet, to be honest, not a great deal to add to my earlier comments. Debtors down, because of that working capital push. Creditors up. That's mainly a function of the IFRS 16 adoptions. We've got about £4 million of lease liabilities in that line. Otherwise, net accrued deferred income continues to be relatively stable year on year, and of course, cash or net debt down significantly year on year. I mean, you may have spotted that actually we have fully drawn all of our facilities. That was clearly a proactive decision that we took as the effects of the pandemic started emerging in late March, early April. So currently we actually hold around well over £30 million. And we thought that was the best approach to ensure that we had maximum flexibility, not least until we saw some of the further impacts of the pandemic, but just more generally, so we can sort of keep an eye on various opportunities, both internally and externally, as they arise in what is clearly quite a disrupted market. Finally, a slide from me on sort of future guidance or current year and future guidance. To be honest, this is largely unchanged from the position that we published a couple of months ago with our full year in terms of longer term organic growth trends. Still expecting PSS to be relatively modest, to be honest, probably high single digits for HY20 given the impact of some of the rebasing from the prior year, but thereafter largely sort of low to mid single digits. Expecting a bit more with EIM, notwithstanding the impact of SaaS with the transition from upfront licenses to ongoing licenses, still expecting quite a bit of growth in that business in the longer term. And content has done quite well for us over the last couple of years, a pretty consistent growth rate, anywhere from sort of 5 to 8%. And notwithstanding the COVID impact currently, we don't see any reasons why that won't continue. In terms of margin, 30% is still our immediate target, and obviously closing H1 at 27. That's huge progress from previous periods. The plan is still very much to hit 30 and exceed that probably around next year. Cash conversion we talked quite a bit about, net debt I talked quite a bit about, and balance sheet, nothing really to add to my previous comments. FY20 still trading very much in line with expectations. We do have a slightly smaller H2 because of the impact of COVID and some of the caution that we've shown in our numbers, but following a very strong H1 close, needless to say, we remain very confident for our outlook.
Thanks, Rob. What I hope to do now is just take you through a few slides that give a little bit of detail into the quality of items that have driven some of that operational performance. as I mentioned earlier, we focus on the 4 pillars program here at Idox. I think when Rob and I arrived, it was clear that there weren't 1 or 2 things that needed to be done to put the business back into good standing. It was a whole array of things. So rather than tackle those things on an ad hoc basis, we put together a program of work that concentrates everyone's efforts from around the company on making a contribution to the turnaround in the business, and then, as we said, providing us with a really strong platform to move forward. So that's focused heavily on making sure that we have really great standards by which we do things, a common operating process that allows people to not just operate well within their particular core of the things they do day in, day out, but then to contribute to others across the group with their knowledge and to use their experience across the group. So, for example, in the last 12 months, we've had people coming out of our EIM business that have very successfully transitioned from enterprise software into cloud-based operations, sharing that with our public sector teams. And conversely, our public sector teams working with the EIM business to look at the way in which we manage programs of work and projects and deliver, commonality in those approaches, such that when Rob, I, and the executive team, which have obviously all been replaced during the same period, get together, then we've got a commonality of terms and we can use our experience well to coach and mentor people through some of the challenges and the reform that we want to drive. And I think that's brought the organisation together much more cohesively over time. Clearly, there's been quite a bit of change, but we're at the point now where that's been embraced as a really successful thing. And as I say, has given us more of a one Idox approach right across the whole group. Now, in addition to that, we've obviously continued to focus our operations. We've come out of some small activity that we had over in the Republic of Ireland, and our final activities over in Malta that were part of the original 6PM acquisition have now been closed. Importantly, we've deployed new sales support tools right across our business. We have one implementation now, Salesforce, and that's allowed us to focus really on clients and our competitive positioning within those clients. So not only can we see actively all the activity that we have across our customer base and which products of ours that they currently have, but we also understand where they are in their cycles of other products that they take from other organizations. And we've been very successful to date at getting out there and helping our clients understand the benefit of taking closely coupled and integrated applications from Idox to replace some of the things that perhaps they bought from others along the way. I can't stress enough this stuff around our teams here at Idox, making sure that we communicate well with them and in the same way that we communicate with our other stakeholders and shareholders. It's really important, I think, that there's just a single story that we continue to tell and excite people with. And I think genuinely people feel that they now work for a very supportive organisation with really strong domain understanding. And I think during this period of COVID, it's actually brought our organisation together a little bit more, if anything. We were already an organisation that worked remotely. Over 80% of our team were already remote workers. And obviously we're at 100% now. Being part of an organisation that understands its strengths, of strong domain understanding, of doing legislative and regulatory work with really fantastic software that's solving really complex issues, I think has enabled what was in the past a very disparate workforce to understand that they have far more in common across our businesses and that they can contribute more to a one Idox approach. As Rob said, we've continued to integrate Tascomi. That's gone extremely well. We're really pleased with the way that acquisition has worked. They've been very successful with new business as well during this 6-month period. So the 4 pillars, I'm not going to go through in too much further detail. I think we've described those in some detail. Happy to take any questions on that when we get to the end. But as well as the 4 pillars within Idox, we absolutely talk about our walk, run, and fly phases. Again, just giving people a clear barometer really on how we're doing as an organisation and how our work's going. And Rob and I went and talked to pretty much all of the staff last November. We did a series of roadshows around the group, and we invited everyone to get their running shoes out because we were ready to go, and they responded brilliantly. So we mentioned our CRM and also our improving use of ERP. We have the Business World products from Unit 4. We have a single instance of that right across the group. When I first came, my view was that we would have a single source of truth in the organisation that will come from our finance systems and from our finance business partners. We're now absolutely in that position, and I think, Rob described the improving MI across the group. Idox is absolutely an organisation now that's making fact-based decisions on data, and that's giving us a tremendous insight, not just to our customers, but to our markets and our market behaviours. Going forward and into this year, we're stratifying our sales efforts, focusing our account-based skills on new business generation and business development. We have a successful telesales operation now underway. We can see that there are lots of small things that we do with our clients that are extremely important. And in my humble experience of dealing with this stuff in the past, clients need to be able to get hold of you, to contact you, to do these small transactions in a really simple way. And sometimes our account-based approach, our field-based approach, didn't allow us to be as responsive as we needed to be. We now have that, and that's going to go extremely well. And we're seeing new opportunities for our IP in new adjacent areas. Small examples: during the course of the year, we've moved our iFit products just from supplying hospitals and tracking assets, people, documents, and move that into the ambulance sector, for example. Before ambulances go out on the road, they need to check that they have a list of over 40 items. Our solution allows them to do that within seconds rather than the 30 minutes it was previously taking, and that's driving a lot of improvements in operational performance for those teams. We're also identifying now new opportunities for IP within our client base and within the markets we serve. And because we're getting much better value from our development activity, both onshore and offshore, we've given ourselves the opportunity to deliver more intellectual property, but from within the same or a similar cost structure that we were delivering previously. So as we move forward through our run phases, as Rob said, I think we're just sort of constantly been improving our performance during 18 and 19. I think when we've laid out our plans to stakeholders and shareholders, we've been very keen to ensure that we guide them correctly and that we move forward in a really positive way. And as we go forward, as Rob talked about, although we absolutely are focused on growth within the group, it's not growth at all costs. We want to make sure that the things that we're doing reflect the strengths of the business, focused around our intellectual property, focused around our domain understanding, and make sure that delivers EBITDA margins and performs right through to cash. So as Rob pointed out, we'll be moving to 30 points margins in relatively short order, and we fully expect that things remaining in a similar way, that the group will be in a situation where it has no debt within about the next sort of 14, 15 months. And the way that we're going to get to that is with the points that we've identified here. I'll cover a couple just for assistance, really. But this thing around stratification that we've already mentioned, I think allows us to focus on our customers, putting the right sales effort into the right activities, and ensuring that in new competitive situations, we can bring the best of our resources to bear rather than have them spread across our account management base and be trapped, in effect, either in regional geographies or in particular product sales in areas. That should allow us to drive growth. And I think also that stratification allows us to identify clear and specific opportunities within our client base where it's both possible and desirable for our clients for us to sell that to them more product that enable them to become more effective in their day-to-day operations. We've also, as I say, given ourselves a really strong platform now, I think, for strategic acquisitions. What I've said so far to our shareholders and other stakeholders is that we do have a list of organisations that are of interest to us and products that are of interest to us. And if the opportunity arises during this COVID situation for those things to come on board, then we want to be agile enough to take that. But we won't be distracted into areas just because businesses become available. Having spent our time over the last 24 months ensuring that we're really focused on the things that we do well, this would not be a time for us to stray from our core messages or to get involved in things that we couldn't leverage through the infrastructure behind the scenes that we've built in our sales teams, professional services groups, and our development activity. So in summary, we've had a lot of improvement across all of our operations across the group. And I think if we look back 24 months on, I think we think we've made really strong progress in a relatively short period of time. We're going to continue to focus on the things that we do extremely well. We make absolutely no apology in talking about margins and cash generation. I think that's implicit in an organisation like Idox that has these really strong market positions and has very long-standing engagements with its clients. Our deep domain understanding and the applications that we bring to bear have good 3 to 5 year contract terms, but often 10 to 15 year engagements with our clients. And so that provides a really firm foundation on which we can continue to on-sell and upsell where it's appropriate to our customers, driving better performance for them. So we're going to continue along and do that. And obviously, Rob's mentioned to a certain extent the effects of COVID. I think we felt at the half year was slightly ahead of where we expected to be. I think the performance has been strong. And we're very positive about our full year expectation and the opportunities for the group. Naturally, we are being slightly cautious about how that plays out at the moment in COVID, but to date, the effects for us have really been in terms of a few delayed projects over the first few weeks of COVID. Subsequently, we're finding that those things are starting to ease themselves through. Customers now are very keen to get on and progress as they obviously get into the new normal themselves. And so that those potential barriers that we perhaps seen are kind of removing themselves, and we're cracking on with projects as we go forward. So we're remaining really focused on the future and very ambitious for it. We're looking forward to continuing the journey we're on and having given ourselves this really strong foundation for growth in pushing that forward over the coming 12 months. So with that, if I can hand back to the team, and I'm sure then we can go on and take any questions you may have.
We have a question from James Lockyer of Peel Hunt.
2 questions from me, if you don't mind, please. Firstly, on your preparing for fly phase flowcharts, you mentioned more automation. I was wondering if you could talk a little bit more around potential examples of what you mean by that, and then in terms of how that might improve revenue opportunities or cost optimization going forwards. And then secondly, you highlighted your ambulance solution. We're obviously saving time in a very time-sensitive industry, so a social benefit as well as cost benefit. Can you help us understand the level of investments that went into to create this ostensibly new solution and new revenue stream, and how we should think about that as an example for other instances, and then obviously other existing IP? Thank you.
Yeah, sure. So the first one on more automation throughout the business. So we've done a huge amount of work around processes. I think is probably the best way to describe it, really, processes and controls. And so what we have today, following all the efforts of the last 15, 18 months, is a lot better MI and a lot more just control, really, across the organization. However, and then there is a however, a lot of that, because of the speed that we've had to move, is still pretty manual. It is still spreadsheet based, for instance. We do a large part of our project management on spreadsheets. Prior to the CRM that we had a few months ago, there was a huge spreadsheet involvement in that. We do quite well with our ERP, but again, we have spreadsheets sort of sprinkled throughout the process, really. So we were sort of moving from a phase where we now have this much richer MI and also much more control to really looking to industrialize that a lot more through actual software applications. So, you know, for our ERP, for example, Dave mentioned we use the solution from Unit 4. It's a very good end-to-end workflow and document management, which then sort of leads into the financials. But for instance, we don't use it for project management, and we don't use it for our payroll, and different parts of the business tend to use it in slightly different ways. And you know, it's deployed on premise, whereas we know that there's a cloud solution available. You know, we don't use the T&E, and I know these are all quite small things, but actually, when you sort of add all those up, they're all sort of marginal gains, really. That as we sort of move from now having the MI and the control, we're moving into much more of a sort of industrialized process. We're looking to really drive more efficiencies across those sorts of things. The CRM is another really good example. You know, the last couple of months we put in a group-wide instance of Salesforce. Now, we did have it in a couple of parts of the business. We didn't have it in our biggest element, PSS, albeit we were sort of managing it fairly manually with spreadsheets. And so again, sort of bringing that all together, not only do we now have much richer MI, but that will also help us in just industrialize some of the workflow going forward. So it's much more focused on, you know, the actual actions associated with some of these processes than it is necessarily about the data prep. So again, you know, as ever, we don't rest on the laurels. You know, lots to do, and we've made a huge amount of progress over the last 18 months, and continuing to build on that to drive more automation generally. The other thing actually I was going to just mention is, whilst we're doing all this industrialization of process, this is all happening at the same time that we're just trying to bring the group's processes a little bit closer generally. So we have some pretty tight processes now with good MR, but we still have instances where different parts of the group are doing things slightly different for various reasons. So to today's comments about the one Idox, you know, this is absolutely the time to look at industrializing some of those things as we bring generally the group a bit closer to its public sector software core.
Yeah, I mean, I'll just add to that. I just say, look, you know, here at Idox, we don't leave things. We address them all with the same amount of enthusiasm, ferocity, the same amount of vigor. You know, we think those small gains are important. If you leave things, then people begin to think it doesn't matter. Well, it does matter, and we drive it with a real passion to ensure that we get the gains that come through. And I think, you know, it's a circular activity. You know, once people see the benefit of doing something, it gives us a reference point to be able to drive forward further reform, because they see the benefit as staff members in the work that they do. You know, if we can clear up 20% of someone's time that's churning away doing, you know, nugatory administrative tasks into something productive, and we can replicate that across all our teams, then the gains to be had are significant. So we don't leave things. We're realistic about what we can achieve. You know, we try and aim high, but at the same time, we're realistic about what we're going to do, but we're continuous in trying to drive that better activity across the group. And, you know, certainly, you know, I'm seeing that net effect in the sales teams. I think they really appreciate, for example, the stratification of the work we do. You know, they want to serve clients well, but, you know, they want to also be out there winning new business that they've identified. So the balance of those two things often is a challenge. So we're removing that challenge and, you know, feeding that through. It becomes a benefit for everybody. You know, to the second point, James, around IP, really keen to ensure that our investment in intellectual property is maximised. And, you know, what we found here at Idox is we have a number of offerings and capabilities across our group that are applicable in near adjacent areas. And the ambulance one is just a good real example of how we've done that recently. There are plenty of others. You know, we've been looking at how we can take, you know, our document management solutions into other niche areas. And of course, the absolute benefit of all that stuff is it's margin enhancing all the way straight through the bottom line, because our R&D investment is not increasing. It's just a reuse of those technology platforms. So, you know, as we've gone through that development cycle, that's the next phase of our work, and we're concentrating hard on how we can maximise the use of our current R&D spend across new areas of operation.
Now we'll go to Steve Robertson from Canaccord Genuity.
I've got two questions, and I think they're both for Rob. Sorry, David, but
fine.
Want to. But, the first one, I believe IFRS 15 pushed 6 million into full year 19 and will push about 2.8 million into the current year. Does that mean that the current year's organic growth is actually penalised around about 3 million because of this change, because of IFRS 15, or is my understanding sort of wrong in that respect?
Yeah, sure. Morning, Steve. Thanks for the question. Yeah, IFRS 15 does undoubtedly have an impact on both FY19 and FY20. So I know we've spoken before about quite sort of high year one revenue take from orders and fairly skinny sort of 2 to 5 year. And then, of course, that's all been reset. And actually, it wasn't necessarily an IFRS 15 thing. It's something that we identified very, very quickly, that we wanted to transition the business to a way of recognizing revenue that was much more aligned to how we actually delivered value to the customer. You know, that's to be honest, that's one of the key things why our cash generation has now been so good, because we are recognizing revenue largely in line with the way that our customers are paying us. And it just so happened that sort of happened at the time that the business was adopting IFRS 15. So it largely sort of came under the banner of IFRS 15, and indeed the way that the accounting worked, that happened. But you're right. I mean, we do have we do have revenues in the current year. So sorry, both FY19 and FY20, which effectively is the release of an opening adjustment moving from IAS 18 to IFRS 15. However, conversely, we haven't been recognizing revenue on the same basis as the previous team had done under IAS 18. So if IAS 18 had continued, then of course we would have been taking much larger year one revenue takes from the TCB, and so of course that hasn't happened. So that's the whole point of the IFRS 15 adjustment, really, is to give us an FY19 and an FY20 P&L that's effectively corrected from both sides, a much more normalized revenue recognition policy from the orders that we take. So a different way of answering or asking the questions is to look at our sort of underlying sales orders. What does that look like? And across the entirety of the public sector business, they've been up very strongly. In the case of local authority, up over 132%. And there's been a lot of, as we've talked about, a lot of sales governance work, process control, account management enhancement that sort of has given us quite a big kickstart, really, from FY18 to FY19 and in particular to FY20. Now, going forward in the longer terms, we talked about the long-term trends of some of these markets in public sector. Whilst we are expecting a fairly big kick from 19 to 20, the longer term trend in public sector has generally been sort of middle single digits. Did that answer your question, Steve? I know it's a little bit difficult to track some of the rev rec policy at Idox over the last couple of years, but hopefully that gave you a bit of a steer.
Yeah, I think I got that, Rob. I've one last question. It's on IFRS 16, so I'm sort of going up numerically here. Just when you set your margin target of 30%, has that target been helped by IFRS 16 adoption, or was that target set with IFRS 16 adoption in mind?
Yeah, to be frank, we never paid it too much attention either way. I mean, IFRS 16 for us is around a sort of 5% on the EBITDA absolute number anyway, so it's not a huge amount of our EBITDA number, but the 30% was effectively a pre-IFRS 16. I mean, our expectations, certainly our plan, is to continue tightening all the operations of the group to exceed 30%. It's definitely our longer term plan to get well over that number. But you are right, the original 30% number was pre-IFRS 16.
And now we'll go to Gareth Evans from Progressive Equity Research.
I've actually got one question for each of you to try and sort of share the excitement. One, first of all, for Dave. Dave, you talked about the sales team stratification. Could you maybe just expand a bit more about the practicalities of that and how it works with regard, I guess, in particular relating to targets and commission? Because obviously it's a laudable aim, but it might be quite tricky to achieve in practice. So it'd be interesting to hear about how that's going and how you look to move it forward. And then one for Rob, the working capital. Clearly, you've had a great result in terms of working capital over the last 6 or 12 or 18 months. Do you think that it's now got to about as good as it can get, or do you think there might be more to go for on the working capital side?
I'll give Rob a 30 seconds on thinking about working capital. In terms of the sales activity, I've done it before, is the honest answer, Gareth. I think the practicality is that genuinely sales teams are rewarded on whatever comes through the accounts that they're allocated. So whether it's telesales or sales desks or internal sales, whatever you want to call it, that's generating that work and fulfilling it, our teams still get rewarded. We think that's an important way of moving forward as a team and as a group. And it means that, that we drive their efficiency and effectiveness and their ability to communicate and work across the organization in a trusted way by making sure that they feel confident to delegate the smaller stuff to telesales groups. And after a while, what we find is that customers directly want to talk to the right people in your organization to get the right piece of information. Certainly when I did this piece of work before and went and talked about our account management functions with our customers, they were always pretty keen that they saw the account team as being the gateway into the company, and so that's why they got used quite a lot. But practically on a day-to-day basis, fulfilling the requirements they had, it wasn't so great. Things could go amiss. Sometimes for various reasons, responses wouldn't be as good as they would hope. So by stratifying that activity and putting it together as a complete support function, then it allows salespeople to have great confidence in the team behind them to fulfill those requirements, and it genuinely allows us to improve the amount of things that we sell to customers that they actually want to buy from us in the first instance. So that's the program, the plan. I think we'll do tremendous things with that during the course of the next 24 months. And I think that just allows us to have more time in new business sales situations, which ultimately will drive the growth in the business.
Mm-hmm. Okay, thank you.
Yeah, morning, Gareth. So then on working capital, it's a little bit of a mixed answer, to be honest. I mean, there are always things to do on working capital. Again, we never rest on the laurels. There's probably sort of two parts to the answer. The first one is just how we operationally sort of manage working capital, and the second one's more about the commercial models that we adopt. On the first, I've been delighted with the progress, and look, there's always more to do, but the reality is, as at today, certainly as at the end of April, we had very, very little debt greater than 60 days, as in very little. Now that was in stark contrast to certainly when Dave and I first started. I remember in my first month, the business had well over 20% of its entire debtor book, possibly even more, 30%. Effectively parked, and this was largely a consequence of the aggressive RevRec, and clearly that's all been fixed. And again, we've now got a business where revenue is very much clearer in terms of the route to cash. So do I think we can continue to get those marginal gains from our cash collection processes? I mean, the answer has to be yes. It always is yes. We talked about wanting to do more of our ERP. Just this month, just last week actually, for the first time, we formalised the way that we bring debtor reporting into our monthly business reviews. Just as an example, we're sort of doing these marginal gains all the time. So I suspect that there'll be more to do, but certainly we're not going to see the sort of big leaps forward that we saw between 19 and 20. Just a very brief note on the transactional stuff. AP was pretty stretched when I first started, and so where we're at today is AP is probably much more of a normalised place. We do pay suppliers to terms, which is typically 30 days. We don't do any shenanigans around the reporting periods to try and stretch creditors and enhance cash. That's all long in Idox's part. So the closing sort of working capital balance and discussion is always as much about debtor collection as it is anything else. Secondly, on the sort of commercial model aspect to it, We are becoming a little bit more open-minded actually in the way that we do some of our commercial models, and it's very, very early days, but we've started to have some internal thoughts around how we can make it easier for us to sell to particularly the public sector, particularly the health part of our business actually, where they're looking for very strong returns on investment of typically 12 months or less, and it's a little bit difficult to shell out for either a big upfront license or in particular multi-years of annuity upfront. So we're thinking about ways that we can be a bit more accommodating to those parts of the business. It's a really small discussion today, but depending on where that goes, and also more generally the sort of structural shift in our business is happening over a number of years, where we are moving from this upfront license model much more to a SaaS-based model. I suspect we will see a bit more of the evening of working capital in sort of medium to long term, but certainly, in terms of the day job today, remains an absolute area of focus.
The last question is from Mike Jeremy from Equity Development, who asks, looking ahead 2 years, what proportion of revenue might be expected from cloud-based services?
Well, thanks for the question. Appreciate it. I think as we go through the next period, without being exact about it, I would think that, and notwithstanding the effects that we may see from COVID, I think if you read most of the articles that have come through in press thinking about, how public services operate and work, then I think there have been clear benefits for those organisations that were already operating in cloud environments, moving to working remotely and having greater flexibility. And certainly across our public sector markets, it would be fair to say that organisations have removed the barriers that pre-existed, if you like, SaaS adoption sort of often been pushed aside. So examples for that would be in our health sector, where it was pretty impossible before to get a virtual appointment with your GP. You'd have to go into the surgery and you'd have to see a GP directly. And I think now, people are able to get those things and make it happen. And it's probably highly unlikely that for minor ailment stuff, people are going to want to go back to visiting their GP. And I think it's the same across most public service operations. So in the near term, I think, over the next couple of years, starting from a relatively small base at Idox, we'd expect that we, in normal circumstances, would be transitioning to about 30-35% of our revenue streams in our public sector business coming from that part of the operation. In our engineering management side, we've already got about 40% of that business that's coming through as a SaaS type business. With an accelerator, who knows? I mean, it could possibly and probably be a little higher than that over the next 24 months.
That's the end of the questions. David, do you have any final comments?
Well, look, we're genuinely appreciative of your time. Hopefully, it's giving you a bit more of a background to the hard work that's gone into Idox over the past 24 months. We're excited about the future for the business now. We think we've got the foundations in place that will allow us to grow. And COVID notwithstanding, we've already built a significant order book here at Idox that will see us, we hope, well through the second half of HY20 and give us a good foundation base for us as we move forward into 21. So thank you for your interest in the business. We think we're in pretty good order. And from Rob and I, appreciate your time. Have a great day.
Yeah, thank you, everyone.